Did you know that a flurry of development projects in Houston's Uptown area is creating a wave of new opportunities for commercial real estate? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoan. Let's get right to it. Houston's Uptown district, particularly the section along Post Oak Boulevard, has long been recognized as a retail powerhouse. Now, developers are revisiting this vibrant area to introduce new offerings and spread the word about its potential. As reported by Jeff Jeffrey from the Houston Business Journal on August 8, 2025, a number of significant projects are currently underway, each set to add fresh leasing opportunities to this already thriving submarket. These developments are expected to diversify the existing mix of office spaces, retail outlets, and dining options, further enhancing Uptown's reputation as a premier destination for businesses and consumers alike. The influx of new projects highlights the dynamic nature of commercial real estate in Houston, offering a glimpse into the future potential of this bustling district. While Houston's Uptown continues to expand, it's intriguing to consider how similar development trends might play out in other markets, such as Kitchener-Waterloo or London, Ontario. In these Canadian cities, the focus remains on multifamily properties and tenant leasing, but the lessons from Houston's retail and office growth could offer valuable insights for cross-border real estate strategies. Reports from Cushman & Wakefield reveal that the Dallas-Fort Worth office market has shown positive net absorption in the second quarter of 2025, continuing the trend from the first half of the year. This marks the first time since the second quarter of 2021 that both direct and sublease space absorption has been positive. Moreover, new leasing activity reached 6.8 million square feet, the strongest pace in 3 years, with mid-sized tenants showing significant activity. Despite these positive signs, there are still challenges. The growth of office-using employment in the Dallas-Fort Worth area has softened, increasing by only 0.7% year over year. The vacancy rate for the quarter stood at 24.9%, maintaining a 20-year high, though Cushman & Wakefield projects a decrease in vacancy moving forward. Bill Cawley, chairman and chief executive officer of Cawley Partners, noted that investment money is returning to the market, indicating recovery. However, he emphasized that the approach to office leasing has shifted. In the past, large blocks of space were desirable, but now medium-sized deals in the range of 8,000 to 30,000 square feet are more prevalent. This change reflects a more methodical approach to filling buildings, with higher asking rents counterbalancing the elevated vacancy rates. Brett Mertz, senior vice president at KBS, highlighted that tenants are now more informed and balanced in their real estate strategies. The focus is not only on high-end finishes, but also on spaces that integrate lifestyle features such as wellness, walkability, and access to retail and hospitality. This trend is prompting investors to enhance tenant experiences with amenities like outdoor collaboration areas and smart building upgrades. Robbie Beatty, vice chairman at Cushman & Wakefield, expressed surprise at the positive leasing activity in the first half of 2025, particularly in Uptown. However, he warned of the limitation of new supply as a potential challenge. Construction levels are at their lowest since 2011, and the completion of a few buildings will leave a shortage of new space available in the coming years. Looking to Ontario, particularly in Kitchener-Waterloo and London, there is a focus on multifamily properties and tenant leasing. These markets could draw insights from Dallas-Fort Worth's office market evolution, particularly in terms of adapting to tenant demands and enhancing property features to attract and retain tenants. As these Canadian markets continue to develop, the lessons from Dallas-Fort Worth could offer valuable strategies for growth and resilience. A significant transaction has occurred on the renowned Rodeo Drive, setting a new benchmark in the luxury retail property market. A retail property housing high-end brands such as Tom Ford, Moncler, and Balenciaga has sold for over $400 million, potentially marking a new record for a single property on Rodeo Drive. This sale also ranks as the second highest in Beverly Hills history. The property, located at 338 North Rodeo Drive, spans 28,114 square feet and was previously purchased by Ronan McNamee's ECA Capital Limited in 2007 for $81.5 million. The recent sale price translates to $14,228 per square foot, indicating the premium value of this location, especially with its development rights. While the identity of the buyer remains undisclosed, the transaction underscores the continued allure of Rodeo Drive as a prime retail destination. The deal was brokered by Jay Lutz of Newmark, with Michael Shabani of Crown Equity also playing a role. This sale is part of a trend of high-value retail investments on Rodeo Drive, with previous notable transactions including LVMH's acquisitions and other significant deals in the area. This record-setting sale reflects the robust demand for luxury retail spaces, a trend that could have implications for other high-end retail markets globally. The strategic purchase with development rights in mind highlights the potential for future growth and redevelopment in such prestigious locations. In Nashville, the Fifth Third Center, which is the fifth largest office tower in downtown, is being considered for a conversion into a nearly 500-room hotel. This transformation comes as the building is currently under contract, according to Sophia Young from the Nashville Business Journal on August 7, 2025. The potential conversion of such a significant office space into a hotel reflects broader trends in commercial real estate, where adaptive reuse of properties is becoming increasingly common. This shift in the use of office spaces can offer insights for similar markets in Ontario, such as Kitchener-Waterloo or London, where multifamily and tenant leasing remain key focuses. The concept of repurposing existing properties to meet current market demands could be particularly relevant as these Canadian cities continue to grow and evolve. In the United States, especially in cities like Nashville, the flexibility to adapt underutilized office spaces into hotels or other commercial uses underscores the resilience of the real estate sector. It presents a model that might be considered in Ontario's urban centers, where balancing office, retail, and multifamily needs is crucial for sustainable development. The industrial real estate sector has long been considered a cornerstone of economic resilience, and recent developments suggest its growth potential is far from reaching its limits. A notable example comes from Gladstone Commercial Corporation, whose second quarter of 2025 acquisitions and occupancy performance provide a compelling case study on how strategic capital deployment and sector-specific tailwinds are reshaping the landscape. Gladstone Commercial's second quarter of 2025 acquisitions of two industrial facilities, totaling 519,093 square feet for $78.95 million, underscore a deliberate pivot towards mission-critical industrial assets. These purchases have increased the company's industrial concentration to 67% of annualized straight-line rents. This shift aligns with the surging demand for logistics hubs driven by e-commerce, nearshoring, and supply chain reconfiguration. The acquisitions reflect a disciplined underwriting approach, prioritizing high-credit tenants, prime locations, and long-term lease terms. With a weighted average remaining lease term now standing at 7.1 years, Gladstone Commercial insulates its cash flows from short-term market volatility, which is crucial in an era of rising interest rates and economic uncertainty. Locking in long-term tenants ensures a predictable revenue stream while positioning the company to capitalize on rental rate growth as vacancy rates normalize. The industrial real estate market is experiencing a classic case of supply-demand imbalance. Net absorption reached 29.6 million square feet in 2025, yet speculative construction has slowed to its lowest level since 2019. While vacancy rates are modestly elevated at 7.1%, the lack of new supply is expected to drive upward pressure on rents. This dynamic is particularly favorable for companies like Gladstone Commercial, which have secured long-term leases and are poised to benefit from tightening markets. The slowdown in construction is not a temporary blip, but a structural shift. High borrowing costs and regulatory hurdles have deterred developers, creating a gap between current supply and future demand. For investors, this means industrial real estate is less likely to face the oversupply risks that have plagued other asset classes in recent cycles. Gladstone Commercial's active pipeline, including 6 letters of intent and a $50 million deal in the works, suggests the company is well positioned to exploit this gap. Gladstone Commercial's 98.7% portfolio occupancy as of June 30, 2025, is a testament to the sector's enduring appeal. Even as broader commercial real estate markets struggle with high vacancies, industrial assets remain in demand. Businesses are increasingly prioritizing proximity to consumers and suppliers, a trend accelerated by geopolitical tensions and inflationary pressures. The company's balance sheet further reinforces its credibility. With $94.4 million in revolver borrowings and $6 million in cash, Gladstone Commercial maintains the flexibility to navigate rate hikes or economic downturns. Its 2024 private placement bond issuance added another layer of financial resilience, ensuring it can fund acquisitions without over-leveraging. For investors, Gladstone Commercial's second quarter performance offers a blueprint for capitalizing on industrial real estate's growth trajectory. The company's focus on high-credit tenants, long-term leases, and strategic dispositions of non-core assets demonstrates a disciplined approach that prioritizes quality over quantity. The industrial sector's resilience is also evident in its ability to outperform other real estate segments. Gladstone Commercial's second quarter of 2025 moves are more than just a response to market conditions. They are a forward-looking strategy to position the company as a leader in a sector poised for sustained growth. Industrial real estate is not a cyclical play, but a structural bet on the future of commerce. As supply constraints persist and demand drivers like reshoring gain momentum, companies with the agility and capital to act, like Gladstone Commercial, will likely outperform. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Haymoon. See you on the next one.